taken on a new initiative in the launch of the Stocks Managed Account (SMA), which essentially is a portfolio of stock holdings actively managed by experienced managers. This may be a clear solution for investors looking to be invested in the equity market, yet have no clue what they should be looking into. As for the seasoned investors, you may probably question just how applicable is the SMA solution to you. Just how is SMA beneficial opposed to individual investors buying into the equity market on your own? Well, most individual investors face time and efforts constraint to look at the equity market. Some may have the bandwidth and time on hand to look into a few country markets, yet those who are more stretched with their time may only have the energy to look into a single country market, or even just certain sectors within the single country market. And few will have the resources to delve deeper beyond. SMA can be considered in such situations to bridge the gap for these investors. iFAST is currently working with Nikko Asset Management in their launch of the first SMA. And today, we have with us Mr. Kenneth Tang, the portfolio manager behind the SMA, to share with us more on the investment methodology and philosophy behind. Hi Kenneth.
Hi.
Thank you for joining us today.
You're welcome.
Could you share with us why is Nikko Asset Management well positioned to be the manager for the iFAST Stocks Managed Account?
Well, in short, Jaslyn, we believe in our people and our process in Nikko Asset Management. The iFAST SMA can help bring together the stock picking expertise and the best investment ideas from our global network of 160 research analysts and portfolio managers. Secondly, we run a disciplined and structured investment approach within our investment teams, where we express our strongest convictions in the portfolios we manage. Investing in the SMA provides us access to the best investment ideas in Nikko Asset Management with high conviction and through an integrated process.
Could you share with us what is the investment strategy behind the construction of the portfolio?
Sure. The investment strategy is driven by bottom-up fundamental analysis and stock selection, and identifying mispriced stocks offering long-term sustainable growth. We look for companies which best exhibit strong positive fundamental change and good sustainability of returns. We also place a significant emphasis in quality and ESG, where quality is defined by companies able to deliver and sustain high returns on capital, and ESG defined as sustainable attributes pertaining to environmental, social, and governance factors.
How is the portfolio being reviewed and managed?
The portfolio is managed as an equally weighted portfolio across 3 equity regions: the US, China via Hong Kong, and Singapore. Within each region, the model portfolio is constructed based on the highest conviction ideas in these respective markets. This is measured by what we call active share. An active share is defined where the positions are weighted differently against the benchmark to outperform or add alpha for the portfolio. The investment objective of the model portfolio is to outperform the respective market benchmarks for these 3 markets. The model portfolio is reviewed actively to ensure the best investment ideas and highest conviction are reflected. Liquidity and turnover are also important considerations, where investment in smaller and less liquid securities, as well as excessive trading or churning of the model portfolio, are avoided. We aim to provide a regular bi-weekly update for the model portfolio.
How many stocks will the portfolio contain?
We believe in running concentrated portfolios and expressing our best active convictions. This would mean that the model portfolio should feature about 25 to 40 stocks, where we have 8 to 12 stocks per market in the respective region. We believe this will best give you a focused portfolio with high active convictions while also providing good diversification across sectors and geographies.
We have seen uncertainty in markets. How will this make us position our SMA to deal with this?
That's a good question. Let's briefly discuss some of the well-documented concerns facing equity markets today. The equity markets today have primarily been concerned about the COVID-19 virus, as well as the ongoing political concerns over US-China tensions on trade and uncertainty over the US elections at the end of 2020. Let's move to the hot topic on the COVID-19 and our views in China. Now, in Wuhan, the infection cases are still increasing rapidly in the region, but the situation outside the Hubei province has actually improved and appears manageable. While Wuhan is still the major concern, we think the worst is almost over and the situation could turn around in the coming weeks. It is however likely that the infection cases may rebound again and more people return to the urban areas from rural areas after the Lunar New Year holiday. We believe the transmission rate, however, should be lower than before because of higher protection and greater awareness of the disease. All in all, we expect the Wuhan COVID-19 virus could last for another 2 or 3 months, but the infection cases could peak within this month. Let's move to the economic impact in China. Overall speaking, we think the impact of the Chinese economy could be bigger than SARS in 2003 because of the high transmittability of the disease, curtailing transportation during the Chinese New Year holidays. And consumption typically during this time is very important. Manufacturing and consumption will be impacted significantly, especially retail, tourist, and hotel and transportation sectors. We think the first quarter of 2020 will actually see a sharp decline in GDP growth. We are optimistic, however, that these sectors will recover once COVID-19 comes to an end. Without policy intervention, the estimated impact on GDP growth could be potentially 0.5 to 1% in 2020. However, we believe the government will take and has taken actually some key measures to tackle these challenges. This includes the reserve requirement ratio cut, the loan prime rate cut, higher deficits on the fiscal budget, and tax rebates. In summary, we think the economic slowdown will be temporary and the Chinese economy will recover to 5.5 to 6% growth in 2021. Now, we are watching very closely for the restart of production over the next coming weeks, and the progress depends on the epidemic situation in Guangdong, Zhejiang, Jiangsu, and Beijing, which is actually quite uncertain at the moment. We believe the process could take almost a month, and the government should actually launch some stimulus measures to help enterprises go through. Now, how can the SMA position amid these times? In China, we remain positive on the economic growth, especially for the second quarter where we expect the economy to rebound from the first quarter. We are focused on sectors that could benefit from this stimulus. We overweight property, financials, and consumer sectors, which could be a beneficiary of this. Longer term, our focus in China is driven primarily by economic restructuring, consumption, as well as innovation. We believe SOE reform will remain an ongoing catalyst for equity performance, and we also like the innovation theme. For example, the COVID virus has actually spurred growth in the virtual home economy, including online games, online shopping, remote office, and online learnings. As a result, cloud computing, IDC, server, and software applications could benefit as a result of COVID-19.
Thank you, Kenneth.
Sure.
How about the situation closest to home, Singapore? What are the investment opportunities all of us can look at?
Well, the outbreak of the coronavirus in China, with cases also in Singapore, will also have significant repercussions on growth for the Singapore economy. The announcement of a budget that is very expansionary, totaling almost more than 2% of the budget in terms of deficit. This is $6.4 billion, which is far larger than what we did in 2003. While differences may appear, our experience with SARS in 2003 is actually the best reference. And during 2003, we saw all key economic indicators fall sharply over a 1-2 quarter period before recovering to a normal period in the quarters after the epidemic has peaked. Economic growth was impacted for about a quarter. While we are hopeful of the same pattern prevailing in this current outbreak, it is likely that the Singapore economy will take a bigger and larger hit in growth due to the greater amount of connectivity with China and the importance of the Chinese economy today as compared to 2003. In particular, the far more aggressive countermeasures taken in 2020 due to the government's proactive mode of engagement imply a sharper short-term downturn for the economy, but it also bodes well for more effective containment. I believe the impact on the equity market in Singapore this time could be different, with today's COVID-19 playbook favouring a less severe sell-off as compared to 2003. Firstly, the level of preparedness and countermeasures by the government highlights greater resilience and confidence in handling this crisis. Remembering SARS 2003 as an equity investor, the number of unknowns and level of preparedness by the government compared to now was very different. The biggest challenge or the biggest change today is that we find the government a lot more prepared to deal with the virus as compared to 2003. This is a strong vote of confidence for equity investors. The second thing to consider is the equity market demography for Singapore in 2003, as well as 2020, which is actually quite different. Corporate earnings today are more defensive by virtue of a greater contribution from financials, and a lower weighting in economic-sensitive cyclicals such as transportation and manufacturing. For example, REITs form a greater representation of the equity market. More than 10% of the STI is actually comprising of REITs as compared to negligible weightings in 2003. Likewise, cyclical industries such as manufacturing and transportation now form a much smaller weighting in comparison to 2003. Most importantly, we find the underlying cash flow generation for companies in the Singapore market to be more resilient and more defensive. Take for example, dividend yields today are now in excess of 4%, almost double that of 2003. Bottom line, we think there's a greater level of resilience in equity performance in reaction to the impact of COVID-19. We featured the rise of resilience as a key investment focus and theme for the Singapore Outlook in 2019. We also built our framework around New Singapore, resilient and sustainable companies that we believe will be well placed in the ecosystem, in the services, as well as representing the future of the economy of Singapore. Now, these sectors are technology, data centers, healthcare, logistics, and tourism. We continue to like these companies, especially those that have strong quality franchises, equipped to ride through these economic challenges posed by COVID-19. We are also positive on the dividend thematic and continue to advocate investing in dividend stocks supported by healthy and structural earnings growth.
What about the other big player in the market, the US?
Well, moving on to the concerns over growth in the US economy and equity markets, as well as the concerns over the US elections, let's cover our US views very quickly. The recent correction of the US markets were frankly a pause for thought after a strong run. For example, as we move into January, the US economy looks to be in good shape. Economic indicators have generally improved so far this year. For example, the much-watched ISM New Orders Index in the US has rallied above 50, back to expansionary levels. And the Eurozone PMI has also staged a modest rebound as well. The tone by central banks and politicians have also encouraged investors back to equity markets. The COVID-19 outbreak caused a little panic, but we think the long-term impact will be more manageable, especially if historical precedents hold. We believe that the overall US economy and equity market supported by accommodative policy is actually looking attractive. Political risk in the US is also receding. Recent events have been removed, such as the risk of impeachment for President Trump. As we move closer to the November presidential elections, it seems unlikely that he would do anything that would undermine his strongest card, which is the health of the US economy. A gradual increase in the US President Trump's approval ratings will certainly put him back to stick to his current path. So in the equity market today in the US, technology continues to be a strong outperformer. The reporting season has actually added further support where many companies have exceeded expectations. Apple, Microsoft, and others continue to generate also significant amounts of cash flow for their management team to either invest in future growth initiatives or to return to shareholders via dividends and buybacks. We believe those positive revisions that we have seen in the US will help to support the premium valuation for US equities relative to the rest of the world. Certainly, the US looks more expensive on most earnings-based multiples, but we believe the US still offers the best-in-class innovation and a lower exposure to market sectors that are facing more structural challenges. In conclusion, it feels like the political headwinds are receding as we move into 2020 and economic fundamentals are reasonable, notwithstanding short-term shocks. We remain optimistic that regarding a pickup in economic growth and equity markets.
How can the SME position in light of all of this?
Well, we like good quality consumer, industrial, and technology franchises in the US, where we find valuations reasonable and also fulfill what we call future quality. We have a structural overweight in healthcare, in the area of medical care, lab diagnostics, and biotech. Some of these names have actually rallied strongly due to the COVID-19 outbreak. We believe investing in these have actually long-term growth propositions that are very attractive. In summary, our take with the recent events in COVID-19 is to remain focused on our equity convictions, be less distracted by the noise and the fear created by this outbreak. For now, we do not consider the risks associated with COVID-19 to hit proportions that could lead to a global recession. We are monitoring this closely, but we believe the best way you can invest is to own good quality growth franchises that can produce high defensible and sustainable returns in both good and bad environments. This is what the SMA tries to do with our Best of Ideas portfolio.
What are the key differences between investing in SMA and other asset classes?
Well, investing in the SMA versus other asset classes will be different from the perspective of expected returns and volatility. In the case of bonds, the SMA is primarily an equity managed account which would have higher return and risk attributes compared to a traditional fixed income or bond portfolio. Given the decline of interest rates and yields globally, expected returns from bonds are likely to be lower when compared to a well-diversified equity portfolio, and the risk volatility from bonds will also likely to be lower, commensurate with lower returns. Now, investing in the SMA, for example, against single stocks will be also different, mainly from the perspective of risk and diversification. An actively managed equity portfolio with 25 to 40 stocks will provide greater risk diversification and lower portfolio volatility as compared to single stocks. The SMA will also be actively managed by professionals, and the investment objective is to outperform or deliver excess or higher returns compared to the market benchmark.
Thank you, Kenneth.
You're welcome.